Welcome to the Full Tracy Money Order Commentary. This is Owen Tracy recording. It's 4:20 p.m. that is Central Time. Today is February 6th, and today I thought we'd kick off with oil prices. They're down another 38 cents today, and that's following through on the reversal from the $80 region last week. The big question in my mind is how much of a risk premium is attached to the oil price. We obviously had a massive drawdown in 2020 where West Texas Intermediate went negative. And that was about as low as oil is likely to go. When we look at the lows for Brent in 2020, $20 is about as low as it tends to get, even in a time when the entire global economy shuts down and nobody can go anywhere or do anything, then oil prices really didn't drop much below 20. Then we had the war in Ukraine in 2022, and the price got all the way up to test the peak in 2008 at around $140. And then since then, prices have kind of been going down. Now, they've been going sideways for the last 2 years, but there's a downward bias to that trade. We can see that there's a sequence of lower rally highs on this longer-term monthly chart, which on aggregate would suggest that there is supply dominance. But then let's also think about, well, why is oil holding out here between about $70 and $80 for at least the last 7 months? Well, I think it's pretty simple that there's a cost of production that is helping to support the price. And it's right there around the $70 area, which happens to coincide right now with the 1,000-day moving average. And at the same time, there's a lot of questions around demand. So that's helping to constrain any kind of significant pop on the upside. So when we start to think about, well, what are those constraints on demand? And of course, demand always has to be viewed in terms of demand growth. So a lot of it has to do with China. Not only is the Chinese Communist Party being very supportive of electric vehicles, but the congestion on roads in China is actually moderating during holiday periods. So at times when people would normally be on the roads traveling back to their hometown or to visit relatives, congestion on the roads has improved, which suggests either there are fewer people from the countryside living in the cities, which is quite possible, but of course what that also implies is that the factory work that was keeping them in the cities in the first place is no longer present. Or it implies that there's a significant recession or a contraction in the economy is a very significant potential risk. Then we also have the clear attempt by OPEC to try and instill discipline and to withhold supply from the market. And of course, it's now referred to as OPEC Plus because of Russia. And Russia is exporting as much as they possibly can, but of course they're seeing increasing sanctions. And there's really no shortage of supply. And the USA is also has been very successful at efficiently increasing its supply. So then it does beg the question, what is the catalyst that's going to break us out of this rather tight range that's been between $70 and $80 over the last 7 months? Well, there are two